Let's start with the top story. Then the rupee has plunged to a new record low today, hitting 62.03 to the dollar in intraday trade. The RBI's latest measures to tighten liquidity in the system and the government's efforts to curb gold imports weren't appreciated by the rupee as it sunk to new depths. The rupee has ended the day at fresh closing low of 61.65 on your screens there. Let's get in then Agam Gupta, who's MD for Fixed Income Trading, Standard Chartered Bank, and he joins us on a Mumbai phone line. Agam, hi, welcome. The market, or rather the RBI and the government now have been trying measures for last 1 month, but nothing really seems to be working. Would you say it's not in the right direction, or the markets are not able to read it?
No, I think the steps are in the right direction. It's just that these steps will play out over the medium term, and there is a mismatch of demand and supply in the immediate term. And secondly, I think today the equity market tanked, and I'm sure that there were reasonable amount of FI outflows from the equity market. So that's why there was a lot of demand for dollars today. As far as the measures go, they will have to play out in the medium term, and they've not been good enough to change the sentiment. But I think over time it will reduce the demand. It will reduce the current account deficit a bit.
Agam, what do you think the markets really are anticipating of the government right now? What steps would really ease the nerves here?
I think, apart from the steps they've already taken, one step which the market is watching out for is curbing non-essential imports by hiking import duties on them. Apart from that, there's nothing else that the market is expecting right now. The talk of the sovereign bond is obviously now off the table. It's not being talked about. On the NRI side, there hasn't been anything big also. But if they announce something big on the NRI side, that would again really help sentiment.
Agam, the markets also are talking about an interest rate hike, given the kind of situation that we are in. And as you said, there's not too much that the government can do at this point in time, and the rupee continues to decline, factoring in or perhaps discounting everything that the government has done.
Well, the rate hike is already there. The short-term rates were raised dramatically, and that has kind of led to a sell-off across the longer end also. Today you had the 10-year bond going to 8.85, so you had a 40 basis point sell-off from yesterday. So, a rate hike is already built into the system. A rate hike is not going to help at all right now for the currency.
So, Agam, in that sense, what's your sense coming in for the Indian rupee going forward? We've already tested 62 today. The next week, how would you see that opening and trading within?
I think, unfortunately, what's happened is that around this time when the measures are being announced, we've seen, dollar gaining against emerging market currencies overseas, and also in the last 2 days we've seen an equity sell-off overseas. So these two are weighing negatively on emerging market currencies and also on the rupee. I think going forward, the rupee will move in line with other currencies, but I would assume that the underperformance of the rupee will reduce now. It won't. We had a situation where the rupee was underperforming all currencies. I think that situation should ease off, and if it weakens further, it would be in line with either, actual outflows and not just on sentiment, or it would be on weakness in other currencies. So I think we still remain on a slightly weak footing, because I believe that the Fed will taper sooner than later, and that will lead to a further kind of risk-off move in emerging markets.
Agam, just coming to back that the steps or the measures that have been coming in from the government, would you say that it's too late, too little? How have you read it? And what's your sense on why the rupee or the equity markets are getting so spooked with it?
I think it's not too little. Some people might think it was too late, but once they came in, they have been announcing, measures quite consistently over the last 2 to 3 weeks. I think there is excessive bearishness which is kind of fed into the market, and it's going to take a little while for the sentiment to change. It's all getting driven by sentiment. People have kind of factored in rupee depreciation, and they kind of look at the measure not good enough to stop it, because there's nothing which is going to immediately bring in dollars or immediately reduce demand. Because the medium-term measures, the sentiment hasn't changed. And as I said, secondly, there has been a global sell-off on equities and on currencies in the last 2 to 3 days. That's also playing on the currency in India. So it's going to take a little while for the sentiment to change. That's the main thing.
Agam, as you pointed about the international markets as well, how much of a percentage would you give to the impact or the factors that we are seeing in the domestic markets and the international markets as well, which is weighing on the rupee?
I don't think I can put a percentage on it. It's just that both the factors are important, and today's move on the rupee was, I think, totally driven by the fact that equity markets tanked and the fact that there were actual equity outflows. And I think that has got to do with the fact that global equities sold off and also global emerging market currencies sold off. So it has quite a good correlation with the emerging market currencies across the world.
Agam, how have you seen the bond yields at 21-month highs? I mean, of course, there's an impact coming onto that one as well. Where do you see the number going forward?
Sorry, on the bond yields, did you say?
Yes.
There was a big sell-off today because the RBI actually did not kind of either cancel the auction or did not kind of they gave the market what yields the market asked for, and after the market got caught off guard and started selling whatever bonds they were holding. I think the RBI's and the government's intention is to keep the short rates tight, and I don't think it's to keep the longer end rates so high. Especially with the fact that growth has been declining, and I think growth will probably take a tumble because of all these liquidity measures which have been introduced. I think the current levels are pretty high, and I don't see bond yields sustaining at close to 9% on the 10-year. I think these levels are a good level to buy 10-year bonds at.
Agam, just pushing you one more time. What's your sense coming in for the currency now? I mean, a lot of reports are coming out with 63, 65 kind of levels. Do you see that coming in?
Well, I think, as I said, I do expect the INR to move in tandem with other emerging market currencies. I think the excessive bearishness of the currency is now going to kind of slowly dissipate because of the measures. It'll happen over the medium term. But yeah, I think like we saw 62 today, I think we can easily go to 63 also. Because as I said, I do expect the Fed taper to happen sooner than later. I do expect that to lead to further emerging market currency sell-off, and I do expect the INR to kind of also get impacted by that. So we can easily go above 62 also if that happens.
All right, Agam, we'll let you go at that. Thank you so much for joining us. So that's the view really coming in from Standard Chartered Bank. The weakness is here to stay. 63 not ruled out in case of currency. Let's also get in then Vijay Bambani, who's author and CEO BSPLindia.com, to get his views on the currency as well. Vijay, one thing that really has been unnerving the market is that every time a measure comes in from the government, they also have to come and clarify. The uncertainty, the clarifications backed by, or the measures backed by these clarifications is something that the markets are not really taking in.
You're absolutely right, Manisha. And if you permit me, I'll borrow a little from historical experience, empirical experience that the markets have. If you remember the currency crisis of 1997, it was primarily a Southeast Asian currency crisis where most of the tiger economies and the non-tiger economy currencies were plummeting. Now, in order to shore up their national currencies, most of the Southeast Asian nations tweaked around their outflow norms. And let's take an example of Malaysia. The then Prime Minister Mahathir Mohamad basically imposed restrictions on the US dollar outflows, and he even had a spat with a very big ticket currency speculator George Soros on international television. Now, what really happened was that the outflows were banned for 12 months and the currency was artificially pegged versus the US dollar. But once these measures, which they were naturally temporary in nature, once they were withdrawn, all hell broke loose. I mean, the minute you try to stop the free flow of funds, big money, which is also scared money, which is fickle money, which is also very, very nervous money, starts to get spooked. And that is what happened in Malaysia. My guess is a lot of today's decline also had something to do with the fact that people started fearing something that has not yet occurred, but they started fearing which could occur, which means there could be tighter controls on outflows of US dollars from the country. And therefore, there was an unnecessary fear in the market, which drove prices, the equity prices particularly down. And my guess is the clarification which you're talking about was required because nerves needed to be calmed. And if history is any indicator, I think this move is unlikely to go very, very well with big money investors.
My point really was, Vijay, that every time a measure comes, if it has to be backed by a clarification, that the market really feels that is there something behind it, is there something more to it?
That's what I meant, Manisha. When I said big money is nervous money, they are anticipating more measures because in the last 4 weeks, it's been raining data points for all market watchers. Now, just when you try and digest the gold import norms which came in via the circular on 23rd of July, just when you start to digest what is happening, then you have curbs on medallions, you have curbs on basically the limits to the overseas direct investments, individual limits to repatriation of dollars and whatnot. I think the markets are basically not being allowed to settle. There are too many data points emerging too fast, and just when the market basically thinks it's got it all figured, you are hitting it with more and more information, and that information is making it nervous.
So Vijay, who's more nervous here, the markets or the government?
I think the markets are a lot more jittery because it is the nature of the market to react in a split second, and sometimes, unfortunately, when you react in a split second, you might also just overreact. I'm not saying that the markets are unwarranted in what they've done, but I think there is an element of overreaction in what has happened. So the markets are naturally a lot more nervous than the government. The government is putting up a brave front and saying, look, all is well. The markets don't think all is well. I also don't think I would be as optimistic as one is indicated to be. But I think that the optimal thing is somewhere in between. The markets are excessively nervous. The governments are excessively confident. The truth is out there in between somewhere.
So Vijay, looking at all of that, what's your sense where the rupee could be trading now in the next week?
As far as I'm concerned, the long dollar short rupee trade is still alive and kicking. Although I don't think the rupee should sink below 63 in a hurry. 63 also is a kind of a stretched out situation. I think 62.80 would be more like it, give or take 20 paisa here and there, therefore the term 63. I think if this follow-up clarification or no other data point is hitting the markets, if there is a certain sense of calm coming back to the market, that there are no more capital controls likely, NRIs can basically feel safe about their foreign exchange deposits here, I think there would be some amount of a pullback rally in equities. There could be a slight pullback rally even in the rupee. So my guess is the range would be 63 on one end and probably 59.80 to 60.40 on the other.
All right, so 60 to 63 is the range that we are agreeing upon in the next week coming in for the currency there.